and welcome to the last QEO of the year. Merry Christmas. Let's hope it is a Merry Christmas. So we've always got a theme. You'll recall last theme 3 months ago here was, are we there yet? Asking some questions about whether we might actually almost be on the cusp of a return to sustained growth. And the answer to that question is no, we are not there yet. It actually has been a rougher few months. And indeed the theme this time we've got is this idea of running rough. And we saw it as an apt description, analogy, I guess, of how this economy is working, where it's a little bit like an old car. On a good day, you can get it going and it looks like it'll go forward. You feel quite optimistic. But then on a bad day, it really sounds like it's not even going to get started at all. And that really does feel like what the economy did, certainly in the middle of the year as well. And that's obviously been a bit of a disappointment. The general theme of our presentation, our view of the New Zealand economy now is that we've had to push out by about 6 months when we think the economy will be getting back onto a sustainable trend growth footing. And that really reflects the setback to the economy we had in the middle of the year. And this is even though the global economy and our trading partner growth actually seems to have done okay, notwithstanding Donald Trump and tariffs and all the other things that are going on. What I'm going to talk to you about is a bit on the global economy, and I'm going to highlight a few trends in some of our biggest trading partners where there's been some interesting things going on. I'll talk about what's been going on in the economy and the sectors that seems to be doing better and worse out there at the moment. Then we'll talk about the medium-term view, our interest rate forecasts, I think pretty important to think about as we're going through into the new year. And then some risks as well around those views. And lastly, my colleague Imre will try to give you a sense of what these markets are going to do, at least for the next few months or so. So globally, what's been going on? Well, actually, it's been quite encouraging, I think, out there in the globe. For most of the last 6 months or so, I've been telling you stories of woe associated with tariffs and the significant risks that there could be for trading partner growth and commodity prices coming from all of that. But actually, what has happened is that most of that is largely blown over, and global growth has really shaken off that global tariff shock. Tariffs are considerably higher in the United States than they have been for the last 300 years, 200 years, there or thereabouts. But they have stabilised, and there are increasing signs that countries have been able to adjust to the tariffs that they have ended up facing, including New Zealand. So when we look at how global growth forecasts have evolved in the last 3 months since I last spoke to you here, you actually see a lot of up arrows, basically, where, especially in the United States, which was the epicenter, I think, of negativity around tariffs, things have panned out to be a lot better than what people feared. Bit more on that in a bit. But actually, Australia's been doing reasonably well. China has not really, the Chinese view hasn't changed, it actually might have soured a little bit. But in general, our trading partner outlook, growth outlook has been revised up. And it's at the point now where it's actually not noticeably very different to what we thought back at the start of the year, before that whole tariff shock was really impounded. Global growth is certainly not hitting its straps on a long-term perspective. We're still looking at global growth that's noticeably lower than what we saw pre-COVID. But a lot of that reflects the fact that China is no longer a 7 or 8% economy. It's like a 4 or 5% economy according to the authorities. Perhaps according to the actual data, it might be like 2 or 3, I would say. Thinking about some of the individual countries, I mean, this is the area where I think most analysts have been really surprised. Like there was a view back in April and May, Donald Trump was going to break this US economy, US exceptionalism was over, corporate America was going to do poorly, the consumer was going to get slammed by these tariffs, the US dollar was going to get trounced. Actually, none of that was true. What we have tended to see instead is that after a pretty weak first quarter, where basically people front-loaded the imports that they needed to do as they saw the tariffs coming, consumption really did bounce back quite strongly in the second quarter. Indications from forecasts in the third quarter continued to be quite strong as well. The nowcasts of the US economy, which admittedly are a little bit hobbled at the moment because there's a shutdown in the government over there, so a lot of the ordinary data is not really available. But the data that we have got continues to suggest that economic growth in America continues at the sort of 3 to 4% range. So as a result, the consensus has really had to revise up a bit in terms of what's going on in America, and that's been a bit of a surprise. On the other hand, the Chinese economy, you'd have noticed in that earlier table, we didn't really have a change in the Chinese economic view in the last few months. And actually, if anything, our sense is the downside risks have increased there. And front and centre, you can continue to see that the consumer remains under quite a lot of pressure in China. House prices, you can see there, are continuing to fall on a monthly basis. There were some signs of optimism a few months ago when people thought that the Chinese authorities were going to deliver meaningful stimulus to the household sector. But actually what has tended to happen with the Chinese is they've gone to type, where they've provided a lot of support to the corporate sector, to the manufacturing sector, as opposed to final demand, and it's not really working. So as a result, there is a bit of downside risk there in that Chinese view, even though the rest of the world is actually looking a little bit brighter, particularly the rest of Southeast Asia in the last few months. In Australia, actually they've had some pretty solid growth. GDP growth there is certainly doing a lot better than it is here in New Zealand. The unemployment rate has ticked up there, and it's got up to 4.5%, which saw markets flirting with the idea of that there could be a few more rate cuts coming in Australia in the next few months. But actually that's all been put to paid by the CPI data recently, and it's seen my colleague in Australia, Lucy Ellis, had to revise back her forecast for when rate cuts would occur into Australia to the middle of next year. And that reflects the fact that Australian inflation in underlying terms is actually above the target range right now, and where markets are trying to work out, well, how long is that going to last? Is that really consistent with further monetary easing? Some more hawkish commentators even talked about the possibility of rate rises in Australia being the next move. The House view here continues to be we get another couple of rate cuts out of the RBA when ultimately some of the inflation data that we saw in the last few months proves to be a bit more transitory, and as that labour market weakens over there. Global interest rates, we think, are still on a stable to falling trend generally. Japan is the exception there. We think we've got probably 1 to 2 more cuts coming in most major parts of the world, the US included. Japan is still expected to continue to normalise interest rates as we go through next year. Getting into the New Zealand economy. So, going back to my analogy about the New Zealand economy being like an old car that just needs a bit of work. Like this breaks down the parts of the economy that we think are probably performing quite strongly versus the ones that need a bit of work, and the ones that are kind of middling. You can sort of see from this table that the strong bits of the economy continue to be anything related to the primary sector, particularly down in the South Island. Those commodity prices continue to be relatively robust. The exchange rate is very supportive for the primary sector right now. So those income growth levels are quite strong. And there's a few parts of the country, particularly down in Queenstown, which are kind of categorised as tourism playgrounds, which are continuing to kind of shake off the general economic malaise that has plagued the rest of the country. And that's all been driven by the level of the exchange rate, global growth, and commodity prices as well. The weaker bits of the economy is anything that relies on the government, because government policy continues to be quite tight with the money. So that's permeating through a lot of the services sector, parts of the country like Wellington, which are quite heavily government related, the infrastructure sector, non-residential construction to some extent as well. You can see that commercial construction industry still looks pretty weak by most indicators. But I think the thing that's really kind of like meaning that the economy is not really hitting its straps yet is that the services sector and that hospitality sector are still not really firing. And that's a concern for growth because that sector is probably 70% of the economy. So until that part of the economy really starts to operate reasonably strongly, we can't really expect to see sustainable growth. And that's certainly what we found in the second quarter when the economy went suddenly backwards quite sharply. The labour market continues to be quite weak as well, and I think that should be quite obvious to anyone. Talk a little bit more on that in a bit. And in the middle, we've got a whole lot of sectors that are kind of looking a little bit better. Retail and parts looks a little bit better. I heard there's a few more cars being sold recently. Residential construction in the form of consents certainly looks like it's starting to pick up, which is an encouraging sign for next year. Housing might be starting to look a little bit better. I'm going to emphasise the might there. Forecasting house prices in the last year has been a nightmare. Global demand, as I pointed out, that's actually still, at least it's stabilised. It's still a little bit subpar, so we could do with a bit more, I think, global growth to really support the economy. And that infrastructure sector, I think, is showing some signs that with a few more months, particularly if the government starts getting some of those shovel-ready projects underway, that something might happen. Ultimately, I think all of these things, what we want is more of these sectors to move from the right to the left, basically. And, that's going to be driven by continued support from the exchange rate and commodity prices. Those are the things that are already doing a lot of the work. And then increasingly, though, we're expecting that to come from interest rates and ultimately an increase in credit demand across the economy through business and through the residential sector. If we look at how things have gone in the last little while, you continue to see that same picture that we've been lamenting on for probably most of this year, where on one hand, businesses are consistently quite optimistic about the future because they see lower interest rates, they see the lower exchange rate, they see other parts of the country potentially doing quite well in the primary sector. So they think that it's going to eventually translate into them. But actually, when you ask them what's actually happened to them in the last few months, it's actually been quite poor. So as a result, what we've tended to see is that GDP output has tended to track what businesses say has actually happened to them as opposed to those expectations. So weak now, hope for the future. It's actually not a bad encapsulation of the forecasts that we've got for the economy. If we look at what GDP has done in the last year, quite a complicated chart here, but I'd focus on two bars. One is the light pink one. That's what Stats NZ claims the economy did in each quarter in the last couple of years, and I'll emphasise the word claim. And the second one I want you to look at is the dark red bar, which is basically where Michael Gordon has estimated what the real underlying growth rate in the economy was in each quarter. And what you can probably tell from your eye is that our estimate of the underlying growth rate is a lot less volatile than what Stats NZ does. In particular, I'll highlight to you that when Stats NZ tells us that June quarter goes down by 0.9%, we'll say, well, okay, where did that lack of growth come from? And the answer is we've got no idea, because it's a balancing factor which basically reflects residual seasonality in the data. It means that growth gets understated in June quarters and overstated in December quarters by about 0.5%, which is massive. So we're stripping out all of that, and what that tells you is that certainly that June quarter, it basically in underlying terms did drop back by about 0.1% or so. That's pretty disappointing because we were expecting that it would have actually had a quarter of growth in the middle of the year. But we then expect to see a gradual improvement in underlying growth as we go through the second half of this year, which we're almost at the end of now. We'll get that data next year. And particularly once we get into the middle of next year, we would expect to be getting to levels of growth which could be correctly categorised as trend. And, if I compare that profile to what I was telling you perhaps 3 or 6 months ago, that whole profile has been pushed out. Instead of seeing that kind of trend growth hitting us sort of like around about now, it's actually probably more than like 6 months down the track. The other theme of things getting pushed back is quite evident in the labour market as well. This is a chart of what Stats NZ has estimated the number of filled jobs in the economy in the last few months or so. Two things kind of obvious from this chart. Firstly, jobs growth has been consistently revised down in the last few months. So even though each iteration of the release has told us, there's a bit of jobs growth in the last month or two, actually when they go back and count again the next month and the next month after that, they've been revising that down. And what it means is that basically that jobs market is still probably flat in the last few months as opposed to starting to grow just yet. So that recovery in the jobs market is really starting to get pushed back. Which brings me to my first question of this presentation. So one of the things that I think is probably quite critical to whether the economy recovers is, when are people going to start hiring again? So from the perspective of your own business, tell me what you think you expect to have by, say, mid-2026. About the same number of people, more, perhaps fewer, or perhaps more that are just working a bit harder. So about the same, or maybe more. So that's not necessarily the most encouraging picture, because I show our forecast at the moment, and we'd expect that by the middle of the year there'd be a bit of employment growth that should be consistently being evident in the data. But it does indicate the nature of the challenge, I think, that a lot of the economy does have right now, where the services sector in particular relies quite heavily on people feeling confident about their job prospects before you can actually see meaningful increases in retail spending, which then encourages increases in business investment and hiring, ultimately in a virtuous circle at that point. In terms of our labour market forecasts, we don't really expect that there should be meaningful growth really until probably about the March or June quarters next year. It's still pretty flat out there at the moment. It's not the same in all parts of the economy. I have another chart that will kind of like show that there are certainly some differences if you look around the country and around sectors as well. But the labour market isn't really expected to significantly improve until towards the middle of next year. That's also been pushed back by about 6 months. We would have probably anticipated that that would be occurring closer to the end of this year if you'd asked me 6 months ago. House prices, flat, is probably the best characterisation for the country overall. Not flat in Wellington, they're falling in Wellington. Continues to be the epicentre of negativity. But, and actually not that flash in Auckland either, to be honest with you. But if we get outside those major urban centres, look at the Canterbury line. I haven't got the South Island centres lines down there, but house prices in Southland, Otago and Canterbury all consistently rising quite strongly. So that does give you a bit of a hint that there are different bits of this economy responding to different parts of the sorts of factors that I was telling you about. And in particular, you can kind of see this here. This is filled jobs growth by region, just like as an example of the sort of indicators you often see here. And you can see there's actually jobs growth going down in the South Island and Southland, Otago, Canterbury. But look at where the negative ones are, particularly look at Wellington, Auckland. Taranaki's been hit because of the oil and gas moratoriums that have happened and the reduction in jobs there as well. But you do get this real picture here that the bits of the economy that are actually most affected by the increase in primary sector incomes and tourism are the ones that are behaving a bit more normally in terms of having jobs growth compared to the major urban centres. And I think that really does drive the quite significant differences in perceptions that you see around the country, depending on where you live. In terms of the primary sector outlook, we continue to expect that we'll get about a $10 payout for dairy prices in the coming year. So that'll be a second good year in a row, and that's coming on top of some significant cash flow inflows to farmers coming from the lactalis sale from Fonterra due next year. On the horizon, we see the potential for falling milk prices. Some of that is built into our forecasts because there has been quite an increase in global supply of milk hit the market. Our own supply has also been quite strong this year. What tends to happen in these markets is that when the price goes up, farmers respond by increasing capacity in supply, and that's what's been happening true to form. But nevertheless, we think the combination of the lower exchange rate and still adequate global demand means that it's still looking quite likely we're going to get a decent payout again this year for that sector. And the sheep and beef, the meat prices remain quite strong. These charts here basically show you where those prices are sitting in inflation-adjusted terms. And what they illustrate is that those prices are all sitting in the upper quartile of the historical experience. So those farmers are doing really well right now on a medium-term basis. There's probably a bit more of a hint there in the lamb market that prices are going to come off a bit because we're starting to see a bit of a supply response come through there. But in the beef market, it takes 2 to 3 years for that to happen. So we're not really anticipating a reduction in beef prices. And this is a classic case of where the tariffs just have not really mattered to that sector very much. A lot of the feedback I get from customers is that the Americans in particular say they need their burgers, so they're just paying for them. So medium term, what's really driving the ultimate improvement in the economy we see from here? And I think front and centre, I'm going to put the interest rates, which have now gotten to quite low levels. as things that should really drive the improvement. I mean, we've got an OCR forecast suggesting that we'll get down to 2.25%, and it could be 2%, depending on how things pan out. We reckon we're about 60% of the way through of the pass-through of the lower OCR through to mortgage holders. So that means there's another, say, 70 or 80 points of interest rate reductions still to come, even from when I'm standing here today. So that sort of stuff we think should have the usual impacts on consumption and investment. If I look at some of the forward indicators, this one was quite interesting data we got last week. The red line there shows you residential building consents, and on the right axis, and the other one is the OCR inverted, because obviously a lower interest rate should ultimately lead higher building activity, building consents, and you can see that residential building market is starting to respond now to low interest rates. It's about a 9-month lag there to what we see today, and there'll be another 6-month lag to what we actually see in terms of actually, spades in the ground doing work. But it is encouraging in the sense that this is part of how the transmission mechanism works. So overall for New Zealand growth, it's going to be a disappointing 1.2% for this year. And I say disappointing because for most of this year I'd have been telling you about something like 2.4% growth for the year, so that reflects the big hole that got driven into the economy in the middle of the year. But we still expect that we'll get 3% growth for 2026 as those interest rates, the commodity prices, the exchange rate really flow through, particularly once we're getting through into the middle of next year, where we really should be hitting our straps. We'll have to go back to the drawing board if that doesn't really happen, because that will probably tell you something about where interest rates ultimately are going to settle, but probably also where the exchange rate's really going to settle as well. Because, like our exchange rate is quite weak at the moment because our growth and our interest rate differentials are quite low. And, that could continue. So then the question that's on everyone's lips, what are house prices going to do next year? Let me know your thoughts. There's a few options there between falling further if you're a real pessimist, or a significant increase of over 7%. Now I'll tell you what we think. The thing with the house price cycle is that it is quite important in terms of driving activity in much of the rest of the economy through consumption and investment via wealth effects. One of the interesting things that we've seen in the last year is that house prices have been flat despite the fact that interest rates have been falling quite a bit. So as a result, we haven't gotten that extra kick in terms of kind of wealth effects coming through into growth in the last year. So here we are, rise broadly in line with inflation. Well, that wouldn't be a terrible outcome, I think. A bit below inflation, well, that would be pretty tough, I think, for large parts of the economy. And then you've got so we've still got a reasonably, I would categorise it as still cautious or perhaps even pessimistic view of what house prices are going to do. If we move on into what we think, well, we basically do anticipate that those low interest rates are going to translate to some house price growth. We've got 5.4% in for next year, which is a bit below average for the sort of 10 years before COVID, I suppose. Certainly with interest rates down here, you might be able to motivate a stronger forecast, but we're trying to be a bit conservative here ourselves because we didn't see very much house price growth last year. So, basically what that would mean though is that if we saw that sort of house price growth with the rest of the macro outlook we've got, probably our housing affordability wouldn't be shifting very much. And it would certainly be a noticeably more positive backdrop for households, probably businesses, than we saw in the last couple of years. So if I go on to the inflation outlook, we think that inflation's peaked at 3%, Satish, so I hope that's right. It's been a tough year for inflation really, hasn't it? Because I think sort of 6 or 9 months ago, most of forecasters would have told you that inflation wasn't really going to rise very much at all, but it did. We think a lot of the factors that drove inflation up this year won't be repeated next year, and I'm particularly looking at things like food and meat prices, which have already done quite a lot of their rises. We don't think that'll necessarily be repeated next year. There are some categories of the CPI that look quite weak to us right now and are likely to be persistent. So, for example, rents are running at really low levels, they're actually falling in flow terms. Construction costs are actually no longer rising. They look like they're as weak as they have been for 20 years. And even real estate agent fees are actually starting to fall out there, which kind of like tells you something about the activity in that industry. Most of those things probably do give you a good sense that it's a reasonable bet to say that inflation will head back towards 2%. We're not really seeing it fall below 2%, partially because none of those indicators are suggesting that inflation is going to dip particularly cyclically low, and tradables inflation, but given that lower exchange rate we've got, is likely to drift up. And I guess the last thing I'll point out there is that, one of the big stories we heard about tariffs 3 or 6 months ago is that these tariffs, it was going to unleash a wave of cheap Chinese imports all around the world as they try to redirect their demand from the US into other markets. And as a result, manufactured goods prices would plummet. That's another thing that totally did not happen, with the possible exception of the electronic car market, where that's been disrupted in New Zealand quite aggressively. So interest rate forecasts, we've got a 2.25% forecast for this month. Could be 2%. I don't really think that's probably going to happen now, actually. There's been no real smoking gun in terms of the data in the last 6 weeks that would tell me that they're going to go with another 50-point cut before Christmas. But it's not out of the question. I think they'll definitely cut rates, though. I don't think you're going to get no change. I don't think the Reserve Bank wants to be the Grinch that stole Christmas. And then next year is next year, isn't it? So we've got a working assumption here that interest rates will stay at these quite low levels until the back end of next year before they start normalising. But we still think that about 3.5%, 3.75% is a reasonable estimate for the neutral OCR in New Zealand. There's probably uncertainty about the length of that year that we keep rates at this level. And part of that, I think, is related to the election, which is going to happen sort of like in the September, October, November timeframe. I think it's quite difficult for the Reserve Bank to be kicking off a tightening cycle during an election cycle. So it kind of leads them to a binary choice. If they think they need to start raising rates, they probably need to get on with it at the start, in the middle of the year. Otherwise, they have to leave it until the end of the year, and we've got a December MPS next year. Right now, we're going with the end of the year, but let's just see how the data evolves as we go through the next 6 months. Risks. Well, I already talked to you about this election, and this is something that we often hear from the business sector as a significant concern. Basically, the polls pretty much neck and neck, really. And I think the interesting thing there is that if you look at the policy platforms that the parties are offering, they're pretty different. So there's a lot of uncertainty there about what that environment's going to be looking like after the end of next year. And I think there is some reasonable possibility that if businesses start to take that to heart, then maybe we get a bit of a pre-election slowdown as everything stops while people assess exactly what is going to happen. But I don't know. What do you guys think in terms of your business? How much impact is that going to do you think will have on your business? You think it doesn't matter because there are other things like lower interest rates that matter? Or do you think it could be a showstopper? All right, well, that's interesting. I mean, people are reasonably saying there'd be some impact, and I think you'd probably be, you'd be taking a bit of risk to say that it wouldn't have any impact on how things go. I mean, I think kind of like how I view this is that it'll really depend on how the underlying momentum of the economy is going once we get to the middle of next year. If things are starting to hit their straps, I think people will set this aside and they'll continue on. If things are still looking dicey by June next year, well then, maybe next year's recovery gets curtailed while people wait and see what's going to happen. I don't really know what the answer to that's going to be because it depends on having an idea of how close the election's going to be and ultimately exactly how the economic momentum's going to be in the middle of next year. The other factor for risks to keep an eye on are these tariffs. If you've been watching the news, the Supreme Court had to hear the legality of Trump's tariffs last week, and from what I could see, the way they're asking, it doesn't look good for Donald Trump. I mean, a lot of analysts would suggest he actually has acted outside his authority in doing what he's been doing in the main, particularly with respect to the across-the-board tariffs of the type that New Zealand's been subject to. The market has responded to that by suggesting that there's perhaps only a 20% chance that when this final judgment comes out, perhaps in January, that the Supreme Court says he can keep them. That means they'll have to change tack. I would suggest that it probably means that for countries like New Zealand, we might not have our tariffs to worry about anymore unless they can just manufacture some kind of national security type issue. For example, there's a big national security risk associated with having too much Sauvignon Blanc in people's hands on Friday nights. Still a lot of trouble, I think, for China and some of the manufactured sectors where that's where he's really been putting his emphasis. But this is something that I think could really shake up the economic outlook in markets as that becomes clearer as we go through the next couple of months. The other thing is just what the exchange rate does. And we've got a fairly negative view in terms of how the exchange rate is going to perform for the foreseeable future. Low interest rates, very low growth momentum compared to our trading partners does not really lend well to a strong exchange rate. This chart here is one attempt I make to kind of like categorise some of the issues from a macro perspective. Imre will have a bit more from a market perspective. But the thing to think about is our unemployment rate is currently really high compared to Australia's, reflecting the fact that our economy is relatively weak compared to Australia's. And as a result, it should be no surprise that the New Zealand dollar, Australian dollar exchange rate is depreciating. In fact, the surprise might well be why it isn't lower than it is already. And indeed, we have a forecast that will see Kiwi Aussie moving towards 85, 86 cents. 2 weeks ago, I was told that's a very heroic forecast. Now it actually looks like it could happen within about 3 hours. So I think watch this space, but more generally, I think particularly if you're an importer, you should probably watch the exchange rate here because there aren't very many strong factors supporting it. What will turn that around is when we actually start seeing those tangible signs of growth returning here and markets thinking no more about further rate cuts, but actually starting to think about when the timing of the first hike might be. And that's when you'll start seeing some FX support, I think. So with that, I'll pass on to Imre and he can tell us what he thinks markets will do.
Thank you, Kelly. But as Chris said, not what markets will do, what they might do. I have no idea what they will do tomorrow. What might they do? Following on from Kelly's theme, Kiwi against the US and the Aussie probably a bit lower, more so in Aussie's case. And for interest rates, we're close to the end of the easing cycle, so you've got to be thinking about things consolidating around here, not really falling any further, and starting to pick up over the next quarter. And if that happens, then you'll probably end up with a gradually flatter yield curve, because the yield curve is very steep at the moment. Okay, a little bit of substantiation. Kiwi US, and looking back on what we said last time we said down, and the answer was down. Why did it fall? Really, two reasons. On the US dollar side, again, Kelly said, the US economy was stronger than the market had expected. So over the last quarter, the theme was still sell the US dollar, it's lost credibility, and the economy is going to start tanking. That didn't happen. So the US dollar was more resilient than expected. And on the Kiwi side, our economy was weaker than expected. It was actually the underperformer among developed markets. So it was singled out for that reason. And so we had that Kiwi US fall. Looking ahead, I think there's potential for a bit more. Our economy's not yet out of the woods. And there are a few US dollar things to think about as well. But we're probably approaching lows for now. And I'll stick my neck out and I'll say maybe 55. And at that point, you'd expect to see a little bit of a rebound up to maybe around 57. So kind of a consolidating, slightly lower outlook for the next 3 months. Just looking at that US dollar, I mean, that has been, as it always is, it's the dominant driver of the Kiwi US. Interesting to look back over the year. And yes, you had a very big fall. That's the red line which depicts the broad US dollar. That's the US dollar against about half a dozen different major currencies. It's kind of like a trade-weighted index, not exactly, but close enough. That fell after Trump's inauguration, because that's when he softly unveiled his tariff plans, and markets went, oh my God. And then he unveiled them with specificity on the 2nd of April, and they were really severe, and the market went, oh gee, run for the hills, sell the US dollar, everything's going to turn bad. And that lasted for quite a while, till eventually it got fully priced. And then it kind of bubbled around a bit, And then we had some negative news on the US economy, on their labour market. The first of the quite weak labour market prints. And US dollar went for another slide. The markets thought, okay, we're going to go for another big leg down. At that point, the world was very, very short US dollars. It was overly tilted in that direction. And since then, the economy has surprised in an upward direction. It didn't take much, but that's caused a lot of people to exit those short US dollar positions. So we've seen a US dollar rebound over the last few months. And that, as I say, has been a major contributor to the Kiwi falling. You know, what happens next is a whole bunch of risks, and I've thrown another one, this government shutdown. So we had some news last night that it passed the Senate. It's got to go through the House yet, but it could, like a best case, this shutdown in the US could end as early as next weekend. And if that's the case, okay, two things are going to happen. Markets will be looking for what are the repercussions now of the shutdown. It's going to manifest in the data. Is the economy going to look significantly weaker as a result of that shutdown? And we're going to see the data unfold over the next few months. The second thing is data has not been released for about 40 days since the government's been shut down. So everybody's flying in the dark. We don't know really how good or bad the labour market is. That's the suspect bit. But the stats department over there will release, as soon as that shutdown finishes, the September payrolls data, and then a few weeks later they'll release the October payrolls data. So we'll get a pretty good sense, and the consensus is that labour data might just be more on the weak side, in which case the US dollar might get hurt as a result of all of that. So there are some negative risks for the US dollar over the month ahead. And that's one reason why I wouldn't be overstating the potential downside for the Kiwi and just limiting that to about 55 cents. Kiwi Aussie, that's been probably the even more interesting exchange rate that we've been following. Last time we said down, and that was correct. We didn't say down far enough because it felt like a stone in the lake. Felt a lot more than expected. And really, that was just a story of the two economies. Ours was weaker than expected. We had a really horrible GDP print for the second quarter, which came out in September, and that surprised everybody. On the Australian side, we've had actually pretty good numbers, to the point where the markets have actually paired their pricing for interest rate cuts. At one point, they had about 3 or 4 cuts in there, and they've whittled that right down to about less than 1 now. So a tale of two very contrasting economies. That's what you're seeing play out here. That it's worth actually looking at a longer term picture of Kiwi Aussie, because it is at a very important juncture. Over the last week or so, it was probing what was a bit more than a decade low. Since about 2013, we haven't seen it down at that level. Over the last few days, it started to break below that. Chartists will look at that and say, gee, that is very, very bearish. And this is a very long-term chart. This goes right back to the Kiwi dollar float. So you can see there is potential for considerable downside. We don't want to sound outlandish. We're sober, conservative Westpac sorts. So we'll just say a little bit lower from here is our base case. But there's potential for quite a big downside there. You can see the bottom of that multi-decade range comes in at around 75 cents, but I would certainly not utter those words just yet anyway. And one of the best ways to reflect economic relative performance is through their interest rates. So if one economy is doing really well and another one's doing weakly, you'll have high interest rate versus low interest rate, and that's exactly what's happening here. Kiwi's got really low interest rates relative to Aussie, and much lower than usual in history. That's the red line there. That's the difference between the 2-year swap rates. We haven't seen that rate since 2012. So we're 100 basis points below Aussie rates. It's very unusual. But again, that's telling the story of the two economies. And that suggests that, the direction of risks in this cross are still, I think, to the downside. Onto interest rates. 2-year swap rate, which is the benchmark, it fell as far as 2.44 about a week and a bit ago. And I think there's a case for saying that could be the cycle low. It fell quite a bit, as you see, over that last quarter. We thought it would fall. It fell a bit further than we expected. And I think the main reason for that was that GDP print that we got in September. It was very, very weak, and it caused markets to reassess how much cutting the Reserve Bank would have to do. But that's all priced in now, and I think from here, absent surprises, we should kind of bumble around this 2.5 mark and eventually start rising, and into next year, higher and higher still. Another way to look at that is this black line here, which is the market pricing for the OCR. You can see it's almost pricing a 2% low, but it's not confident enough to completely price that in. So it's saying, yeah, 2.25 OCR low is done with some chance of 2%. That's more than enough. That's quite fair. That suggests that absent a surprise, you wouldn't expect swap rates, which are essentially a composite of all of these black points, won't go any lower than they are now. So swap rates, cycle low, I think is the main message here. Also interesting to note that the interest rate markets have started to price in something of a tightening cycle. It's very modest compared to Kelly's one, and even Kelly's one is not actually humongous. But what will happen, I think, the way it should play out is if, say, November is actually the low, and it looks like the low to the market, and the RBNZ kind of says in clouded language, that's it, you'll see that black line steepening up quite quickly. And I'll start pricing in that tightening cycle very quickly. Now, if it doesn't happen after November, then it's quite likely to happen after February, which is the ensuing meeting. So sometime over the next couple of meetings, I would expect markets to start pricing in higher and higher short-term interest rates. And finally, just a couple of little detail things. People are wondering, okay, so if you get that last cut in November or outside chance in February, how long is the Reserve Bank going to stay on hold? And so we look at all of the past cycles, and you have easing cycles and tightening cycles. You look at the tightening cycles, which are in black, it's quite easy. They're fairly consistent around 10 or 11 months. That's how long they stay on hold. But after an easing cycle, it's all over the map. It could be 4 months, could be 36 months. That doesn't tell you a lot, but it does give you a kind of a window. We're thinking roughly a year, which certainly falls within that band. The reason you get that variability, though, post an easing cycle is easing cycles are all about dealing with uncertainty, so it's a much more uncertain outlook that they're dealing with. So then they stay on hold a lot longer to make sure they've done the job correctly. But yeah, there's a big range, so history doesn't tell us too much, except that our view of around a year seems about right. It's not outlandish. The other thing markets people are asking us a lot is how soon, how far in advance of the next tightening cycle will markets start pricing in that tightening cycle? Because we know markets are really preemptive. They've got to be first on the job to make money. And here's the history of the past tightening cycles and how much in advance markets started pricing in it into the 2-year swap, i.e., when did it start rising noticeably? And you can see there's a bit of a range, but it's the median's around 10 or 11 months. So Kelly's got the first hike in there penciled in at around November of next year. That makes complete sense from this historical point of view. So you'd expect either very late this year or early next year that markets, based on this, should start to price in something of a tightening cycle and higher short-term interest rates. Okay, I'll leave it there. Thank you very much.